Silver had been one of the most explosive markets anywhere in the financial world, climbing relentlessly and pulling in traders who believed they were witnessing the early stages of a once-in-a-generation move. Prices surged at a pace rarely seen in precious metals, volatility expanded dramatically, and daily swings grew large enough to rival assets normally associated with far more speculative behavior. Then, almost without warning, silver reversed hard. What looked unstoppable suddenly wasn't, and the speed of the decline caught many market participants completely off guard. To understand why that happened, it's necessary to step back and look at what drove silver so high in the first place, and why markets that rise this fast almost always face a moment of reckoning. The rally that preceded the crash was historic not just because of how high prices reached, but because of how quickly they got there. Over a relatively short period, silver pushed far beyond levels that had capped price action for years. Intraday ranges widened dramatically, signaling intense participation from short-term traders, hedge funds, and momentum-driven strategies. Volumes surged across futures exchanges and retail interest spiked as headlines highlighted silver's outsized gains compared to other metals. When a market moves like that, it creates a powerful narrative. Scarcity, inflation protection, industrial demand, and monetary uncertainty all merged into a single story that reinforced itself day after day. As prices climbed, fear of missing out replaced caution, and buying became increasingly emotional rather than analytical. That emotional phase is where the seeds of the crash were planted. After extreme gains, profit-taking becomes inevitable. Large players who entered earlier at much lower prices do not need a fundamental shift to justify selling. They only need prices to look stretched relative to recent history. As silver pushed higher, those early positions moved deeply into profit, and the incentive to lock in gains grew stronger with every volatile session. Once selling begins at elevated levels, it often feeds on itself. Stops are triggered, momentum indicators roll over, and short-term traders rush to exit positions that only days earlier felt untouchable. The futures market played a critical role in accelerating the decline. Silver is heavily traded through leveraged contracts, which magnify both gains and losses. During the rally, speculative positioning expanded rapidly as traders increased exposure using borrowed capital. When prices started to slip, margin pressure intensified. Positions that looked safe during the ascent suddenly became fragile. Forced liquidations followed, not because traders changed their outlook on silver, but because risk controls demanded it. This kind of mechanical selling has a way of overwhelming the order book, pushing prices down far faster than fundamentals alone would suggest. At the same time, macro forces began to lean against silver. The US dollar strengthened, making dollar-denominated commodities more expensive for international buyers. Rising bond yields increased the appeal of interest-bearing assets relative to metals that generate no yield. Expectations around monetary policy also shifted as traders reassessed the pace and timing of future rate decisions. Even subtle changes in these expectations can have an outsized impact on silver, which sits at the intersection of precious metal sentiment and industrial demand. When the macro backdrop becomes less supportive, markets that have already run far ahead of themselves become especially vulnerable. Market psychology amplified everything. Silver is known for sharp moves because it attracts a unique mix of participants, from long-term holders of physical metal to fast-moving speculative capital. Unlike gold, which is often dominated by central banks and conservative institutions, silver trades with a more emotional profile. When prices rise quickly, confidence turns into conviction. When prices fall, that conviction can evaporate just as fast. Momentum exhaustion is a real phenomenon, and in silver it tends to show up violently. Once buyers hesitate, the absence of new demand becomes obvious, and price has to fall far enough to entice interest again. Institutional traders and hedge funds typically thrive in these conditions. During the late stages of a parabolic move, many begin reducing exposure rather than adding to it. They look for signs that volatility is peaking and that upside momentum is becoming unstable. When the reversal begins, these participants often shift into defensive mode, cutting risk, hedging exposure, or stepping aside entirely. Their goal is not to predict the exact top or bottom, but to preserve capital while the market finds a new equilibrium. That process can feel chaotic to retail traders watching prices move rapidly in both directions. As silver pulled back, attention turned to key price zones where the market might stabilize. Areas that previously acted as breakout levels often become zones of interest during corrections. When prices pause or slow near these regions, it suggests that buyers are at least evaluating value again. If those zones fail to hold, the market may need to move lower to reset sentiment and flush out remaining speculative excess. None of this implies a permanent shift in silver's long-term role, but it does highlight how corrections are part of the same cycle that creates historic rallies. Several paths now lie ahead. Silver could enter a period of consolidation, moving sideways as volatility contracts and traders reassess positioning. This kind of pause allows emotions to cool and fundamentals to reassert themselves. Another possibility is a deeper correction, where prices retrace a larger portion of the rally and test whether longer-term demand is truly as strong as it appeared during the surge. There is also the chance of a volatility-driven rebound, where sharp selling exhausts itself and prices snap back as short-term pressure fades. Each scenario depends not on a single factor, but on how macro conditions, liquidity, and sentiment evolve together. Going forward, several signals matter more than any single price level. Movements in the US dollar often provide early clues about pressure or relief for silver. Interest rate expectations shape the broader environment for precious metals. Economic data influences perceptions of inflation, growth, and industrial demand. Market sentiment, visible through volatility and positioning, reveals whether fear or confidence is dominating behavior. Watching how these elements interact offers far more insight than reacting to daily price swings alone. Silver remains one of the most emotionally charged markets in global finance. Its dual role as both an industrial input and a monetary metal ensures that it responds to a wide range of forces, often all at once. Historic rallies and sudden crashes are not anomalies in silver. They are part of its character. Understanding that reality helps explain why the recent move unfolded the way it did, and why periods of extreme excitement are often followed by moments of sharp recalibration. In a market driven as much by psychology as by supply and demand, uncertainty is not a weakness. It is the environment in which silver has always operated, rewarding those who respect its volatility and punishing those who underestimate it. Silver's behavior in moments like this also reflects something deeper about how modern markets function. Liquidity flows quickly, information spreads instantly, and positioning can become crowded faster than ever before. When silver was rising, the story was simple and compelling. Inflation fears, industrial demand, geopolitical uncertainty, and distrust in fiat currencies all pointed in the same direction. That alignment rarely lasts. As soon as even one of those pillars shows cracks, the market starts to question how much of the price was driven by fundamentals and how much was driven by momentum. The recent crash was not a rejection of silver as an asset, but a rejection of the pace at which prices were moving. It's important to understand that markets do not move in straight lines, especially after historic rallies. The faster the ascent, the more fragile the structure beneath it becomes. During the rally, many participants entered the market late, buying not because silver was cheap, but because it was rising. Those positions tend to be weak. They depend on continued upside to justify staying in the trade. When prices stall or reverse, those traders are often the first to exit, adding fuel to the decline. This is why pullbacks after parabolic moves often feel exaggerated and emotionally intense. Another layer often overlooked is the role of volatility itself. As silver's daily ranges expanded, risk models at banks and funds automatically adjusted. Higher volatility increases the amount of capital required to hold positions. When volatility spikes, some institutions are forced to reduce exposure regardless of their view on the metal. This creates selling pressure that has nothing to do with whether silver is fundamentally strong or weak. It is purely mechanical, and it tends to show up suddenly, adding to the sense that the market is falling apart without a clear reason. Physical silver markets also react differently than paper markets during periods like this. While futures prices can swing dramatically within hours, physical demand tends to move more slowly. Premiums, delivery times, and inventory levels do not adjust instantly. This disconnect can confuse traders who assume that futures prices perfectly reflect real-world demand. In reality, futures markets are driven by expectations and positioning, while physical markets respond to longer-term trends. During sharp corrections, that gap between paper and physical can widen, reinforcing volatility rather than calming it. Silver's relationship with gold provides additional context. Gold is often treated as a reserve asset, held by central banks and institutions with long-term horizons. Silver, by contrast, attracts a higher proportion of speculative capital. This makes silver more responsive to shifts in sentiment, liquidity, and risk appetite. When confidence is high, silver can outperform dramatically. When confidence wavers, it can underperform just as quickly. The recent crash fits that pattern perfectly, highlighting once again why silver rarely moves quietly. As prices adjusted lower, the market began searching for balance. This process is rarely smooth. Buyers and sellers test each other repeatedly, resulting in sharp intraday moves that can feel directionless. This is the market gathering information, gauging how much selling pressure remains and whether new demand is willing to step in. During these phases, headlines often become contradictory, with some narratives emphasizing opportunity and others warning of further downside. Both can coexist because the market itself has not yet decided. Institutional behavior during these periods tends to be patient. Large players are less concerned with catching exact turning points and more focused on risk-adjusted positioning. They observe how prices behave around key zones, how volume changes, and whether volatility begins to compress or expand further. Silence from institutions should not be mistaken for lack of interest. Often it reflects a deliberate decision to wait for clearer signals before committing capital again. The broader macro environment will continue to shape silver's path. Inflation data influences expectations about purchasing power and monetary policy. Growth indicators affect industrial demand assumptions. Central bank communication shapes currency trends and yield dynamics. Silver sits downstream from all of these forces, reacting not only to the data itself, but to how markets interpret it. That interpretation can shift quickly, especially when positioning is already stretched. One of the most important lessons from the recent crash is how quickly narratives can change. Just days earlier, discussions centered on new highs and long-term shortages. After the sell-off, the conversation shifted to risk, leverage, and downside scenarios. Neither narrative is complete on its own. Markets oscillate between optimism and caution, and silver tends to exaggerate both extremes. Recognizing that pattern helps cut through the noise and reduces the temptation to react emotionally to every price move. As silver continues to trade through this volatile phase, uncertainty remains the dominant feature. Prices may stabilize, they may fall further, or they may rebound sharply. What matters most is not the exact path, but the understanding that corrections are a natural response to excess. They reset expectations, redistribute risk, and create the conditions for the next meaningful move, whatever direction it ultimately takes. Silver has always been a market that tests patience and conviction. It rewards those who respect its volatility and challenges those who assume momentum will last forever. The recent crash serves as a reminder that historic rallies do not end quietly, and that understanding the forces behind both the rise and the fall is essential to navigating one of the most dynamic metals in the global financial system. Silver remains one of the most emotionally charged markets in global finance. Its dual role as both an industrial input and a monetary metal ensures that it responds to a wide range of forces, often all at once. Historic rallies and sudden crashes are not anomalies in silver. They are part of its character. Understanding that reality helps explain why the recent move unfolded the way it did, and why periods of extreme excitement are often followed by moments of sharp recalibration. In a market driven as much by psychology as by supply and demand, uncertainty is not a weakness. It is the environment in which silver has always operated, rewarding those who respect its volatility and punishing those who underestimate it.